Hello and thank you for joining us for today's webinar. This session is being delivered as part of our Tourism Enterprise Development Programme. We've been working closely with industry over the last number of months to shape and roll out this programme and respond as best we all can to the unprecedented events of 2020 and the ongoing impact of COVID-19 on the industry. You can access a range of COVID-19 support materials as well as signing up for webinars and expert advice on tourismni.com and covid19.tourismni.com. We've initially prioritised financial support, including financial planning, setting financial targets, cost-based analysis and pricing, as these are areas that continue to be raised with us by the industry. We would encourage you to continue to feed in on priority areas. If you could complete the feedback form following today's webinar, we can continue to tailor the programme to your needs, or indeed at any time, just feedback through tourismni.com or covid19.tourismni.com. I hope you all found today's session useful and informative. Thank you.
Thank you very much, Rosemary. My name is Feargal McCormack. I'm the Managing Director of PKF-FPM Chartered Accountants, and I'm delighted to be joined by my colleague today, Ashok Thomas, a Senior Manager. And together, we hope to present the webinar on seeking and securing finance for Northern Ireland tourism businesses. And in terms of the presentation context, the webinar is being delivered as part of Tourism NI's new Tourism Enterprise Development Programme. And at the outset, I may say that the slides will be an aid memoir. It means that they're a complete reference source afterwards, but both Ashok and I will not necessarily be talking to each slide. And it's fair to say at the outset that choosing the right type of funding depends on various factors relevant to your business. And hopefully this webinar will help you clearly identify the criteria that you should consider in choosing the type of funding required and appropriate funding partner for your business. It's designed to help businesses operating within the Northern Ireland tourism industry, and it will include an overview of the range of finance options available to in the current market environment, and the importance of cash flow management, along with some key insights on how to prepare your business proposal to successfully secure finance. Towards the end of the webinar, my colleague Ashok Thomas will provide some practical tips on integrating the appropriate financial modelling techniques into your funding proposal. Now, at the outset, may I say it's acknowledged that there may be one-to-one mentoring available to enhance knowledge and understanding of specific elements of the webinar, and that will be, I'll give more details on that actually at the end of the webinar. The evolving coronavirus pandemic means that we're currently living and working in unprecedented and extraordinary times. And for businesses operating in the Northern Ireland tourism sector, most of whom have experienced a cessation or significant reduction in revenue through phases of non-trading, then trading, and now again non-trading due to government restrictions and public health guidelines, there is no simple blueprint or roadmap forward in terms of seeking and securing finance. And I think it's important to also acknowledge that there may be unique issues being caused by the coronavirus pandemic to your particular business. Yes, COVID-19 will end, but the reality is that from a business perspective, we must currently plan for living with and post-COVID-19. And as highlighted in early webinars, an economic crisis perhaps is a good time, albeit we never planned it, to take a holistic look at our business, including seeking and securing finance in order to reflect, respond, and rebound faster in the context of applying, hopefully, tomorrow's logic to today's turbulence. With the prospect, hopefully, of full trading recommencing shortly, hopefully before Christmas, we'll keep our fingers crossed. Now is the time to plan and to try and ensure that your business is well placed to exploit the recovery of trading with and post COVID-19. With the out-of-state visitors market likely to take some time to come back to prior COVID-19 levels, the home market and staycations must become top priority for marketing strategies, with the emphasis on the island of Ireland. Yes, it's fair to say that a new business landscape is evolving, with expected changes in market and consumer behaviour and attitudes. And we will all have to learn to do business in different ways. And as a result, we must focus our attention, I would suggest, on re-engineering our business model going forward to be effective in seeking and securing appropriate finance. Now, just like us, finance providers will also have adjusted their criteria to reflect the new economic challenges created by COVID-19. For example, they're likely to pay particular attention to the ability of the business to fund working capital requirements. And believe it or not, they may wish to review the tourism business's policy and risks and how they treat advance deposits and vouchers. For example, re-advance deposits and vouchers, they may wish to know, does your business ring fence these in a separate bank account and reflect it as deferred income in your accounts because you haven't yet earned it? And they may wish to assess, to be honest with you, the ability to you to repay back this in case some of the people who gave you deposits wanted to seek them back again. And to be fair, what they're really looking for here is a reassurance that you did apply the matching principle to your accounting records and also in terms of deposits, and that you recognized that although people gave you this money in advance, you have not yet earned it because you haven't yet provided the service or product required. Now, we all know in behind that will be the key area of actually cancellation. And it may well be that if you don't cancel the event, then ultimately you're entitled to hold on to the deposit. But that will vary case to case. And it's also fair to say that you couldn't currently, as we all know, thankfully, you couldn't currently be in business at present and not be aware of the importance of the COVID-19 supports and unsecured loan assistance. And again, we cover that briefly as we go along. It's not the exact purpose of today's webinar. So what we hope to achieve by the end of the webinar, we hope that you would have a greater understanding of the cause of funding requirements, the sources of funding, why cash flow management is essential, particularly in a period of an economic crisis in terms of not only the funding itself, but actually securing funding, because any funder will look and focus on cash flow management immediately. Approaching and preparing a proposal to seek finance. Then, as I said, Ashok will come in and help us to illustrate how a financial model may support your proposal and be an integral part of your proposal. And finally, we'll give some hints on assessing a funding proposal from the other side, what the funding provider might look for. So in terms of funding and cash flow planning, it's fair to say that planning is needed for the funding and the cash the business requires, when it requires it, and where it will come from. And all of this really must be underpinned by a risk assessment, forensic and sensitivity analysis. If you think about it, managing expected receipts and payments, inclusive of any estimated error, so allow for a little bit of error. And the strategy for commercial revenue will vary significantly depending on the activity sector, the size, and the product or service that your particular tourism business provides. However, it's fair to say that there are many aspects of funding in these unprecedented circumstances that all tourism businesses will need to consider. And we've tried to make today's webinar generic in that context. It's also fair to appreciate that there are financial barriers to funding. And funds are usually required to grow a business. And whether this is to invest in new plant and machinery or premises or research and development or entering into new markets, the truth is that without these funds, it can be difficult to take advantage of opportunities as they arise. And therefore, it's important to consider how funds can be obtained and best utilized by your business. Now, the very first and key, one of the key points we wish to get across today is, if you have a funding requirement, you don't immediately ring the bank. Because believe it or not, this turns out then to be a fundamental weakness of your proposal and you'll be caught out. The most important thing, if you think you have a funding requirement, is to pause, stop, and ask yourself, what is the cause of the funding requirement? Why am I needing a fund? Why do I need funds? Is it to fund cash losses? Is it to fund working capital? Is it to fund a capital investment in a new property or plant machinery? Is it to fund research and development, international trade and entering overseas markets, which we'll not cover on much today because of the current environment? Or is it, believe it or not, which is important in the current environment, is it to fund a business acquisition? Because some people will definitely use the current market environment to pursue potential business acquisitions. And we're seeing that already actually in our own office. It's important also to acknowledge that cash flow within the business can be supported by a few smart moves, by seeking an extension from creditors or negotiating reductions on outstanding debts. Another potential thing, if you're trying to look for early wins, as the person says, would be to refinance existing unencumbered assets or sell assets that you do not need. Sell them off, they're surplus to current requirements. Now, there's no doubt about it that the COVID-19 supports and unsecured loan assistance have been a significant help to business, albeit not perfect. We'll talk about the various other forms of source of funds throughout the presentation. And it is equally important to appreciate at the outset that the balance between risk and reward. The greater the risk is from a funding perspective, the greater the reward. But equally, you have to appreciate that the cost of return then has to be lower. So debt, for example, has, you may not think it, but has a low interest cost because that interest cost is fixed. There's no risk. If you don't make a profit, you still have to pay the interest on your debt. Whereas if you take equity, which is promoter's investment, if the business doesn't make a profit, unfortunately, the owner gets no return. But if the business makes super profits, then the owner who's taken all the risks gets rewarded. Now, in terms of cash losses, well, first of all, a lot of us are experiencing this in our business at present. And, if you think of funding them, initially, it probably was available surplus working capital finance if you're fortunate to have anything. It's then promoters' funds, personal savings. It could be finance, indeed, from family members, loans or gifts from family members. It certainly could be the COVID-19 supports and unsecured loan systems. And, to be honest with you, never in my lifetime has there been such assistance required. But to be fair, the governments have stepped up to the mark, albeit you're never going to get a perfect scenario. And it could equally be agreeing deferrals for your existing business commitments. But that's how you go about trying to fund cash losses. It's immediate. You don't have much planning there. You have to get on with it. Now, it's fair to say that maintaining a healthy working capital is one of the most important factors of a business is to be successful. And depending on the nature of your business, there might be periods during the year when the cash flow becomes restricted. And therefore, it's important to be aware of ways to improve the working capital position for troughs and peaks at a particular time during a year. And some of the ways to manage that we suggest in terms of customers and debtors is perhaps to offer credit terms to customers offering that is often a necessity in order to generate sales. But that can mean it takes several months to receive those funds. Similarly, you may consider invoice discounting or factoring, which provides an immediate cash flow benefit to grow the business. What happens is somebody buys your debtor book and you get cash in, but then you have to wait for the customer to make the payment. Early settlement of discounts is another way to deal with this in terms of customers and debtors. You might encourage customers to pay early or on time. Now, this can certainly reduce your debtor days and improve your cash flow to fund future growth. However, one has to be very careful here because if you're giving discounts that's reducing your margins, you have to be careful that it's important that the sales, and we covered this in a previous webinar on pricing and costing, it's important that the sales and growth is sufficient to offset the loss of income as a result of the discounts offered. Equally, small, simple things you can do. Are you getting your sales invoice out in a timely manner? That's very important. I can tell you among our client base, we have some clients who wait to the end of the month. We have other clients who issue it there and then. It's amazing the difference in terms of cash flow. And are you carrying out credit checks? We in one of the earlier seminars, we talked about credit being for vanity, or turnover being for vanity. It's a very dear and costly mistake when you sell people a lot of service and goods and then can't get paid for it. So don't be afraid to do credit checks. And on some occasions, it may be better to forgo the sale than to take the risk of not getting paid. I think we've all experienced that busy fool situation from time to time. And currently, we're all very exposed to that. It's a high risk just in the current market environment. In terms of loans or bank debt, I mean, obviously, first of all, you have an overdraft facility, and it's very important to appreciate that it's there to really fund short-term cash flow and working capital. It's not there to fund the acquisition of plant and machinery or indeed premises or to fund the business acquisition. It's also there you can help out with seasonal repayments for a business with, you think about a high level of demand over a certain period of the year. And in that case, actually, you might even consider going to the funding provider and saying will they agree to seasonal repayments, with higher repayments being made in the months when the cash is earned most as a result of the seasonality of your business. Certainly review interest payments and make sure you're getting good value, or should you even consider paying off a particular loan and refinancing it a different way. In terms of stock and work in progress, we touched on this in one of our previous webinars, but just to cover it in the context of funding, you got to ensure that you're holding the right level of stocks, because too much stock can result in a higher risk of it becoming obsolete, theft, unnecessary storage costs, insurance premiums too high, obviously overstaffing, and unnecessary borrowings, tying up cash. You remember we talked about the stock turnover ratio in our key performance indicators webinar for those who were, I was going to say, fortunate to join us, but let's put that a different way, for those people who were kind enough to join us. In terms of leasing, obviously it's also important to appreciate that with constant changes in technology, it might be more efficient to lease equipment rather than purchasing it outright. And for existing equipment, again, consider a sale and a leaseback, whereby although you own the equipment, you now sell it to a lessor and you get a cash injection back into your business. Certainly coming back to those favorite friends and family members, they may be, if working capital is restricted, they may help you out in the short term. And we're certainly seeing a lot more of that just at present, family members helping out businesses at present. And that is an important source of finance. Okay, now moving on to funding the acquisition of property, which can be a very major decision for businesses. Financing new premises can certainly be problematic, and especially where profits have been reinvested elsewhere in the business. So funding options might include, obviously, commercial loans, also investing personal funds or obtaining grant funding. In terms of commercial funds, what we mean in this case would be commercial loans, and they can be used to help finance the acquisition of the property. They're normally over a considerable period of time. And you may unfortunately have to provide the security of the property to the funder. And in some cases, personal guarantees may be required. And I would urge you to be very careful in personal guarantees and try, if you can, to cap them. In terms of grants, to be fair, grant funding may be available to help the acquisition of the property. And this normally will depend on the objectives and the priorities of the funder. And projects where funding might be available from a grant perspective would normally relate to areas of innovation, sustainability, and job creation. Now, in terms of perhaps investing your own personal funds, you could obviously decide to use your own personal wealth because you think you might get a better return in investing in this particular premise. And indeed, as we covered in a previous seminar, you may wish to use some pension funding you've used. For example, use your SIP or a SAS to fund business premises. It's also fair to say that some things that are quite often overlooked at the time and not thought about is tax allowances and tax considerations. For example, it's very important if you're buying premises to give some thought to perhaps reclassifying what you may think is property, but if you can reclassify it as integral fixtures or fittings, then instead of qualifying for a capital allowance of 3% on the structure of the property, you can qualify for 18% on the integral features, because they're deemed plant machinery, even though you probably think they're property, but they're not from a tax point of view. And similarly, if you happen to be involved in acquiring land remediation, where there's a remediation of land involved, you can get a corporation tax relief at 150%. There's obviously the VAT aspects and the stamp duty, which again, I have to be careful. I'm only highlighting these, but make no mistake about it, they're very, very important. Now, in terms of investing in plant and machinery, obviously a very common strategy to grow your business. This growth can be achieved through improved productivity or internal efficiencies, or obviously the quality of products or service as a result of the investment in the plant and machinery. The funding options to reduce the initial cash outlay can include perhaps using hire purchase or leasing solutions, as well as, again, potentially grant. And we'll cover these very briefly. In terms of HP, what happens here is the cost of the asset is paid over an extended period, and that reduces the immediate cash flow implications for an outright purchase. There's also tax relief if it's HP, believe it or not, because it's deemed as if you own the asset, potentially 100% capital allowances. And similarly, basically, if it's within the overall annual investment allowance for the year for your business. And similarly, basically paying for the asset over time to allow the cost and the benefits derived from that cost to be matched can also be very good and very helpful from a cash flow point of view. It's also fair to say that in terms of leasing, which is different to HP, it's very important, the two are not the same, but costs will be incurred over the lease period, avoiding again one large lump sum. And tax relief can be reclaimed on operating lease payments. Again, it's fair to say in respect of leasing, too detailed to go into today, but you need to read the lease agreement very carefully to ensure it's correctly presented in your accounts, and more importantly, that you are implementing the correct tax treatment. And again, just like property, grants can be used to help with the purchase of plant and machinery, particularly if they're part, again, of an innovative or sustainable project, which will help create employment opportunities. And ultimately, obviously, you can also take out a term loan to fund plant and machinery. In terms of funding research and development, high risk here. So again, unfortunately, it's back to promoters' funds are quite often grants, and there are very attractive grants to encourage R&D. And more importantly, there's also a very significant tax incentive called R&D tax credits. And even if you're not making money, believe it or not, if you have carried out eligible R&D expenditure from a tax perspective as recognized by HMRC, you can actually get cash rebates. So it's very important, and certainly we're seeing more and more people using that. In the current environment, believe it or not, people are looking at opportunities to buy what they consider good value in terms of business acquisitions. And again, there are specific types of funding which are required. Certainly commercial loans is the most likely one, by leveraging against the existing assets of the new acquired business. And it's fair to say you need to be very careful in terms of any covenants that are being imposed and the way the business is currently operated, and keep your eye out again for personal guarantees there. You may be able to refer to get some type of finance or deferred credit from the seller. You could have a deferred consideration tied into performances over the next 1 or 2 years. But equally, in some cases, for example, where there's a buyout maybe from an existing, say, owner to somebody they've identified as a friendly successor, they may be willing to give a loan over a period of time and get it paid back as the business that has been acquired continues to generate cash. And again, we're seeing that now becoming quite common. Personal funds, again, pension-based income. It could well be that you're using a SAS or a SIP to assist with part of the acquisition. And you then also, in terms of acquisitions, if you think it's a very good business opportunity and you can't fund it and you can't get normal finance for bank finance, you may look at, for example, business angel finance or indeed venture capital funding. In that case, you've got to always consider what would be the exit strategy for those you're seeking the third-party funding with to help you do the acquisition. So again, we're all very conscious currently with the COVID-19 supports and unsecured loan assistance. By their very nature, this is a separate webinar on its own, but obviously you got to make sure you familiarize yourself with the potential assistance that you can secure under this, whether it be if your business is currently not trading under the current Northern Ireland Executive Local Restriction Support Scheme. Obviously, the new job support scheme has come in to replace the CJRS, the Corona Job Retention Scheme, and you hopefully will be eligible in terms of your furlough workers in the past for the Job Retention Bonus Scheme in the new year. Again, for the purpose of you happen to be self-employment, obviously you come on under the self-employment support scheme. I'm not going to go through the various other reliefs, but you can see they're captured there on the slide and as a reference for you in your own time. In terms of bank support, you had the bounce back up to 50,000 unsecured. And again, I know a number of businesses, because we've been involved in them, in the tourism sector, have benefited from the coronavirus business interruption loan scheme. Again, there's limits on PGs up to 250,000 if memory serves right, and above that you may be required to give PGs. In terms of traditional bank funding, to be honest, working capital we've already covered, which is overdraft, invoice discounting, and in some cases a stocking facility. Asset-backed finance we've covered in terms of term loans, HP lease facilities, and also chattel mortgages could well come in for a high value asset or property. You can also get commercial loans to fund the growth expansion, which I think we talked about. And then there are specialist loans in certain instances, and I'm not going into them today, but for example, if you had a very large project, you could maybe perhaps benefit from a European Investment Bank funding. In terms of grant assistance, again, there's a whole array of potential grants depending on your particular business. But the truth is, in terms of Tourism NI, the capital grants program is just concluded, but hopefully it'll come again in the not too distant future. There's various revenue grants. For example, there's one currently, they're seeking expressions of offer for consultancy advice. But again, Always keep your eye out if they're relevant to you. Similarly with Invest in I, if you happen to invest in I client, various levels of grants will be marketing, R&D, employment, training, R&D, etc. And similarly, I've listed the other sources of most common sources of grants available. I'm not going to go into them, but the key to any grant is to first of all look at what the objectives of the grant program is. And if you think your project meets those objectives, then make an application. But please, one golden rule: never do anything for grant alone. It can be the most dangerous decision you ever take in your life, because grants can be clawed back if you don't get them right. In terms of venture capital and business angels, venture capital provides long-term monetary investments in exchange for equity in the business. It's certainly a form of risk capital, and it complements the owner's own equity. And unlike bank debt, it has no guarantee of repayment or interest, but then back to the risk reward, it expects a greater reward. The majority of venture capital firms target business requiring over about 150,000. They're quite interested quite often in managing buyouts and managing buy-ins. And on the other hand, business angels, they tend to invest between 15,000 and 150,000 in startup and early stage funding. It's fair to say business angels can be very attractive because quite often these networks feature highly successful self-made entrepreneurs who are looking to acquire shares in potentially lucrative early start businesses. So it can be a very attractive source of finance to help you out. And similarly, if your business happens to qualify and meet the requirements of an enterprise investment scheme, which is a tax approved scheme, it can be very attractive for the investors investing in your business. I just want to cover very briefly two other forms of funding. Peer-to-peer loans are becoming more peer-to-peer lending platform becoming more common. For example, some of you may have heard of the Funding Circle. They arrange loans from groups of individuals or organizations or entrepreneurs looking to grow, two entrepreneurs looking to grow. And it's a way for a business to get funding without having to visit a bank. And lenders can use the platform just like a marketplace where they choose who they want to lend to. And similarly, I suppose, not totally dissimilar, is crowdfunding. And crowdfunding portals, basically, they offer a wealth of lending opportunities for startup and entrepreneurs. And what happens here is you can pitch on a crowdfunding website for a sizable investment in your business model with the ability to attract multiple investors to invest small amounts towards achieving your final total desired. Unlike traditional forms of finance, crowdfunding is not directly repaid, and startups may instead opt to offer their investors some form of service in return for their financial support, such as, for example, free samples of their products or whatever, some amount of free accommodation per year. Now, I'm not going to go into alternative sources of finance. Suffice to say, I'm leaving this slide in the pack. And again, if somebody wants to go into these, I suspect there wouldn't be that many in the webinar today involved in this form of finance. If they contact Tourism and I, we'll try and help out on a personal basis to provide further advice. So let's look at the funding providers. If you think about what are the key criteria they're looking for, well, the first of all, want to know what is the level of funding you require and the purpose. That's back to the cause. They want to look at, you want to demonstrate the ability to repay the borrowings. Is the business case you're making realistic? Now, I can tell you, as one who quite often appraises various proposals for funding, you'd be shocked how far I could be into the proposal before I've established exactly what level of funding do they require and what's the purpose. Now, if you think about that, it's hard to believe, but that's true, I can tell you. It's amazing the amount of funding proposals are so poor. Again, you've got to demonstrate the growth potential for the business, and you've got to demonstrate anybody can create figures and project them. But the more important thing is you have to demonstrate that the project promoters have the ability to deliver the project. Now, in terms of assessing funding, it's fair to say there's some basic funding principles. You borrow for long-term needs with long-term debt. That's why in terms of plant and machinery, in terms of premises, you basically try to fund the asset over its useful economic life. And you borrow for short-term debt, for example, working capital needs to grow the business in the short term. You borrow for that with short-term debt. You match the term of the term of the loan or the lease or the HP agreement over the expected useful economic life of the asset. And certainly we're finding that whilst it may be difficult to ultimately secure finance is still available. Now, you may say, why is cash flow management essential? Well, it's fundamental in the whole concept of of seeking and securing finance. And the reason for that is that certainly as a result of COVID-19, there has been a significant disruption to cash flow in terms of, you think about decline in current and future sales, issues with debtor collection and issues with reduction in suppliers' credit. There could be increase in certain costs of materials due to supply issues. You could have increase in costs of doing business, as many of you in the tourism sector know, due to putting in place procedures to facilitate social distancing requirements. You could also have foreign exchange volatility. You could have delays, hopefully not too many at present. I think, to be fair, there's been a fair effort made not to have delays in grants and supports, but you can go on. You could be stock can become obsolete because your business is closed down for a month or 2 months. So cash flow management helps to navigate the way forward. It helps chart the way forward, particularly over the next 6 to 12 months. And in a period of economic uncertainty, it goes right to the top. And it helps to ensure the business is protected and able to recover quickly, hopefully post the pandemic. It ensures that you only borrow what you require and what you are able to service, because people don't want to give you money if they don't think you're going to be able to pay it back. It helps honor commitments to your suppliers and also obviously to your employers. And it assists in planning the right combination of various government-backed lending and supports currently available under COVID-19. And certainly it's useful to plan various scenarios, including extended disruption period. And Ashok, I think, will probably touch on this also in his financial modelling section. Now, in previous webinar, I focused on this. I'm just touching on it now, but I'm touching because you can't look at funding and not be conscious of the difference between profit and cash. You know, you often hear people saying, "Are you sure I made a profit because I've less money now than I had at the start of the year?" And yet their profit and loss account is showing a profit. And the reason for that is very simple. The cash is not profit. And profit, as we've defined in a previous webinar, is the difference between the total amount your business earns and all of its costs, usually assessed over a year, but it could be over any particular period, where cash is the amount you have on hand now to pay debts. As we've said, you can be showing a good profit and unfortunately not have the cash to fund working capital or indeed to pay your next debt as it falls due. And one of the things you have to be very careful to avoid is overtrading. And that occurs when the business expands too quickly without having the financial resources to fund such a quick expansion. And unfortunately, I've been involved in a few of those businesses trying to sort them out or turn them around, and it's difficult once it hasn't been spotted in advance. And in terms of that, this little case study highlights very quickly the difference in profit and cash. For example, two companies, A and B, exactly the same sales, exactly the same cost of sales, 80,000, sales 100,000, same profit 120,000, and same net assets 20,000. But let's look at the difference. Company A, for example, it has been paid 40,000 of its credit sales, so it's still owed 60,000, trade debtor 60,000, and it is paid 30,000 of its suppliers, and therefore it still has trade creditors. It owes 50,000. So if you think about it, very simply, it has £10,000 cash, so it's positive 10,000. Company B, on the other hand, it has actually only received 20,000 from its credit sales, so its debtors are now 80,000. It's still owed 80,000 from its customers. On the other hand, it's been very good to its suppliers, and it's paid 50,000 of the 80,000, so it only owes 30,000. Now, believe it or not, in these two cases, if you take your time to study them in your own time, you'll see that actually Company A is £10,000 positive cash, and Company B, same profits, same turnover, and same net assets as Company A, has actually got an adverse bank overdraft or negative cash of 30,000. So you can see a very significant difference in these two case studies. And what we're really saying here is that in terms of financing your business, cash is the lifeblood of any business, really needs to be looked after. Robust, rigorous, and regular reporting, very important in cash flow to keep it right, and self-discipline and cash management, particularly in the current environment, and keep your eye on costs. Remember, you can quite often control costs, you can't control the revenue side. And this is just in this context we talked about earlier on in the presentation. There's three core elements in the working capital cycle: debtors, creditors, stock, and work in progress. Now, in terms of cash flow, obviously it's cash in the start of the period, money is received during a particular period, and the cash remaining at the end of the period. So it really focuses the mind totally purely on cash inflows and cash outflows. And there may be times when you could not simply have enough ready cash to meet your commitments, and that's because your income and expenditure rarely coincide. Now, just briefly, because I think it's important to appreciate this to understand the whole area of funding identifying the correct source of funding and then how to get it. If you think about the cash flow cycle, cash goes into your business either from cash sales or accounts receivable, which is your debtors, or alternatively from borrowing capacity from a variety of funders or shareholders' input. And then once it goes into the cash, how does it go out? Well, it goes out first of all on stock or direct expenses or wages in order to provide your product or service. It goes out towards your paying for your fixed overheads, perhaps paying for tax, paying for plant and equipment, interest, and indeed if you're a limited company, dividends, and if you're a sole trader or a partnership, drawing. So that's where the cash goes, and you need to have a basic understanding for that, and then what causes the cash problems. Obviously, clash in the economy as we're seeing at present, insufficient working capital, that leads to insufficient funding, unplanned growth, quite often poor credit control, maybe outside your control just at present, people having the ability to pay you. And we're not talking about international trading today because out-of-state visitors are obviously not around at present, and we've already referred to over trading and obviously under trading. If you don't have business in the first place, then you have a problem. You can improve your cash flow from obviously working on all those things: debtors, creditors, stock, assets, costs, trading patterns and volumes. That's the seasonality issue. And obviously the most important thing is to try and link it all together with a little bit of cash flow forecasting. So let's get to the stage now where we're now starting to prepare our proposal to a bank, or indeed the truth is, if you're preparing it to any funding organization, so long as you realize you first of all find out what's the objective and you're going to the right funding supplier, then really a lot of the core principles are the exact same. So I'm going to use banks for our case study, but a lot of this would apply no matter who you're actually applying to for funding. Basically, certainly in the case of banks, they're keen to work with their existing clients and build on a trusted relationship. A sensible mix of debt and equity is normally important, and it's fair to say it's important to appreciate, it's back to the risk reward table we showed earlier on, to appreciate that banks are not there to take an equity risk for a banking return, because they only get a fixed interest return. Banks will want to see the project promoters, unfortunately, but it makes logic, accepting some pain, and they'll always be looking for that commerciality, reasonableness check, and they may disagree with you, but that's what they'll be looking. That's where they'll be looking at KPIs, etc. We'll come back to that later on, and keep coming back. Does the bank proposal look realistic in the context of the market, the competitors, and the returns out there? Now, basically, in very simple terms, I try to give you a rough outline here of a bank proposal, but it is important you get the structure of the proposal right. Actually, it's probably more important you pause for a second and get this right before you put your pen to paper. Too often people jump into write, but actually, if you can structure, it doesn't need to be a big document, quite a short document, but it needs to be very focused on what you're trying to say. So, executive summary, obviously, business overview, the impact currently in the current environment of coronavirus, your historical financial position, the outline business case going forward. What do you think it's going to look like? Financial projections with achievable and realistic assumptions. The funding requirement and the funding request, if that's what it's for, if you're seeking funding. Identify the KPIs that are key to your business, and SMART. We talked about this last week, the KPIs, SMART objectives. If you think about it, with specific, measurable, attainable, realistic, and time-bound. And apply sensitivity and scenario analysis to the potential options. Now, in terms of the executive summary, again, I'm not going to go through every one of these points, but really what it should do is, most people, remember, don't go by the executive summary. If they're not interested, haven't read the executive summary, they won't go on. So it does need to have key business highlights, summarize the key strengths of the business, and why under normal circumstances going forward, it's worthy of support. State the reason for the funding, as we've said before, and the amount of it, obviously. Highlight if you wish to secure bank finance under the various schemes where you're applying for the bounce back or the coronavirus or the loan scheme, you're using those. And simply then, it's common sense, where possible, indicate the ability of the business to service it. Now, do not submit a bank proposal without knowing before you submit it what are your projections showing in terms of debt recoverability, ability to pay the debt or pay the interest. Debt basically is interest and capital, where interest is just interest only. So again, all makes sense if you think about it. There may be some cases where you have to provide security or PGs or covenants. Again, be very conscious of those and be upfront about them. Rather than the bank coming looking for them, state you don't want them or you do want them, and if you're not going to provide them, why you're not providing them, why your project can stand up without it. The business overview, obviously quite simple. You get straight into, what currently is involved in the business and what's the markets it's going after. And again, highlight management expertise here, very important, roles and responsibilities of your team. And if you have unique unique differentiators here, unique selling points. Don't be afraid to highlight them in here. This is where you would highlight the why. And also, obviously, if Brexit you think is going to affect your business seriously, put that in there in terms of the future in the short term anyway. And then obviously we talked about the coronavirus impact, and again, what impact would have on turnover. Obviously, first of all, suppliers in terms of and staff. Look, I've listed a few things there, but I think we now unfortunately we all know too well the impact coronavirus is having on our business. And then basically link to those key risks, highlight very importantly the steps, because if you think about it, the future is projections and estimates. You have to highlight what you've done already. What steps have you taken to currently mitigate and manage cash flow? And again, it could be rates relief, it could be deferring VAT, it could be cutting back costs, it could be reducing significantly the scale of some of your operations, it could be re-engineering your business model and the various grants you may have got as well. But that'll vary from business to business. And again, describe the cash flow constraints and challenges that are arising. And again, detail any actions that you've been taking to address them. Really important, because that's very important. If you can prove already what you've done, you've been effective, you've been smart in terms of responding agile to the situation. Now, it isn't, there's no doubt about it that having a track record it can be very helpful. And in this regard, your most recent financial statements, your most recent management accounts, in the current environment, I think you'll find banks are now going to ask you for a list of your current trade debtors, your current trade creditors. They may also ask you, by the way, for a list of those things I mentioned to you, your advanced deposits and your vouchers, to get a feel for how much you have in those and how you've provided for them in terms of your accounts. And then look for a very brief commentary on historical performance and obviously your current bank facilities. So then you outline the business case going forward. This is the most important, because you think about it, this is what you're asking a funder to give you money based on what you're saying you're going to deliver. So very important that you look at it. It's a real good opportunity to demonstrate that you're taking that holistic view of your business, that you're resetting, refocusing, and you're going to rebound faster. You're going to come out of this better than you've gone into COVID and into the current economic challenges. Good idea to include any opportunities that perhaps you identified that may have result as a result of the coronavirus, and again how you're planning to address social distancing going forward in the short term, perhaps maybe in the medium term. Potential changes, for example, in food demands, whether it be healthy foods, etc. And obviously, we have to be realistic in terms of out-of-state visitors and the emphasis now in the short term on the island of Ireland, staycations, etc. On whatever business we're involved in within the tourism sector. Now, it's fair to say that we have to then show what are we going to try and do differently. It could well be we're moving to a 24/7 services, that those services may actually grow as you find more and more people work from home, flexibility, and they may work the 24-hour clock. I think you'll find that, as we're already seeing, that the younger generation are certainly less fearful, and perhaps we might maybe look at customer tolerances and maybe target specific groups as we think they may be more willing to come out and give us business than others, and develop strategic alliances with various other activity tourism providers that you can enhance the mutual business opportunities of both your business and theirs by coming together and marketing some initiatives. Now, it's fair to say that whenever you get into your actual bank proposal or funding proposal, probably the most important thing is actually the assumptions, because actually, to be fair, as I've said before, any fool can create a set of projections, but it's haven't been able to prove that they're credible based on the assumptions you've picked. So you will have to look to ensure you have achievable and realistic assumptions. And I think Ashok will touch this now in a second when he gets into the financial modelling, but you'll have to make assumptions sales and cost of sales, credit sales and non-credit sales, again in terms of your costs. Remember what we covered in previous seminars in recent weeks between fixed, variable and semi-variable, and again outline key components. We talked about the policy advanced deposits and vouchers, your labour resource going forward, the impact of furlough or indeed the job support scheme, and then again into your various funding things and the costs associated with any grants you hope to get. So I'm just trying to set the scene there, and I'm delighted now to pass over to my colleague Ashok Thomas, who'll take you through how financial projections play a very integral part to your proposal to seek finance. And I think Ashok will try to demonstrate to you there's nothing to be afraid of in financial projections, but the most important thing is to pause and think and understand, are they realistic based on what you know about your business? So over to you, Ashok.
Thank you, Feargal. In this section, I want to give you a brief overview of what financial projections are in the wider context of seeking funding. Now, to ensure that the financial projections that you create are fit for purpose, purpose being useful for the lender to assess your funding or your bank proposal, you will first need to assess how does the lender or funder use the financial projections that you provide them. So in summary, there are obviously, depending on the type of funding you're seeking and depending on their own internal process, there are, if we could just summarize them and we can think of on a very high level, what are what are the common things that they look for in the financial projections? We feel there are three things that a funder will look for. Number one, it is the funding requirement. What does the business need in terms of, is it working capital funding? Is it for a new project? Is it for an expansion? Depending on the type of funding that you need, they will need to assess the amount and the quantity of the funding that you need. And Feargal has touched on this subject as well. The second thing that they'll assess is obviously the debt serviceability. Now, depending if there's a repayment schedule, then they'll look at your historical performance and they'll look at your future performance and they'll see, right, is it possible for the business to continue generating enough of profits and cash flow to ensure that they not only service the debt capital repayment, but also the interest commitments. So it's the second thing that funders and lenders look at. And the third thing is also very important. It is also to assess the asset base of the company in terms of fixed assets, your working capital, your cash reserves, and what your net asset position is. So in summary, there are three things that the funder will be looking to assess from your financial projections. Now, let's look at each one of them in detail. So first, let's look at assessing the funding need. So here is an example of a cash flow projection, which starts in May 2020. It goes all the way up to April 2021. So depending on the software that you use, in our earlier series, we'd actually covered on how to create financial projections. So, and we talked about you have different methods of creating financial projections, one of which is using a software. You can also use Excel spreadsheets and build a financial model using spreadsheets. So in this case, we've used Microsoft Excel spreadsheets to build a financial model. So what we've done here is we've assessed what the opening bank position is, and then we've looked at what money is expected to come into the business, what your inflows are, and what your outflows are. And that gives you a good grip on what we think the cash flow position is going to be at the end of the month and the period, and then of course the year in April 2021. So the first step, obviously, in your financial projections, whichever method that you use to create financial projections, will be this cash flow that you create and what you see here in the slide. So depending on this, as you can see, this particular example, this business starts with a positive position of 35,000 in the beginning of May 2020, but by the end of the month, it's negative 40,000. So there's so much of a cash burn. And then the next month it increases further, and then the next month it increases further. But then we see a turnaround for this particular example in August, and you see the shortfall reducing, and then it being a positive cash position by Feb 2021. So what does this tell you? So once we've created the cash flow model, we sort of know what the funding requirement is going to be. So in this particular case, the peak funding here is in the month of July, where 93,550 is the closing cash balance. So you're overdrawn your bank balance by so much. So once you've created this, you can actually assess based on whichever scenario that you plan for. You can actually assess what your cash flow funding need is. So you can actually, depending on what you've created here, you can actually decide to borrow probably £100,000. So you have enough reserve, enough cash flow and funding to ensure that you have enough headroom to cover the COVID disruption period of May, June, and July. So to actually present it better, we've actually presented this in a graph. So as you can see, there's a dip that goes all the way down in the month of July, and it peaks in the month of July, and it's close to £100,000, and then it goes back up slowly. So, so this is a very useful tool to sort of help you assess what the funding need is, right? And this is exactly the same reason the bank or the funder or the lender will use the cash flow projections. The next important part of of funding is the debt serviceability element. So the question will be asked: is the business able to fund the repayment and the interest, the capital repayment and the interest commitments of the loan that you're borrowing, right? So the first step is to get a set of P&L projections. So we talked about cash flow projections earlier, which is extremely useful to see what funding you need. And then you look at the debt serviceability element of it. So here, depending on the model that you use, it might be a software package that you use to model your financial projections, or you might just use it in Excel. So in this case, instead of a monthly, we've actually prepared a annual set of accounts. So in this set of projections, if you look carefully, we've actually benchmarked 2020 as against 3 years of projections. So that'll give you a good idea of what historical results were and what we expect them to be in the next 3 years. So again, in the previous series, we've actually covered on how to go about each element of sales and cost of sales, gross profits, and all the overhead costs to sort of see how can we best project the future performance. So using all those inputs and those assumptions and what you know about the business, you will need to project out the forecast for this, let's say the next 3 years. Now, you may decide to do a 5-year cash flow. That depends on what your lender needs. But again, in this particular case, we've actually done a 3-year projection. So as you can see, this business did about 30 million last year, and it's expected to grow to 35 to 42 to 50 by year 3. So just taking this example for a moment, the number that's very important is the operating profit, right? So what is the business generating in terms of income, net income? And is it sufficient to cover your debt service capacity? So the next slide goes through what the lender is looking for. So the first thing is understanding the cash flow available. So that's very simple. You take the operating profit that you get that we looked at the previous slide, and then you add the depreciation, which is a non-cash expenditure. So you add that back and you see what your cash flow generated by the business is. Once you've done that, you assess what the loan repayment commitments are for the next three periods. So in this case, there's no old loan. So this was a proposal for a new loan. So there was no historical loan. This was projected. So that's why you see 0 in 2020, but you see an amount for loan repayment of capital and interest from year 1, year 2, and year 3 onwards. Now, Feargal will cover this in the next few slides as well, but it's very important to know that the lender will need to understand what your debt service capacity is and what your debt service coverage ratio is. So it's a very simple exercise, and you can do that on a very high level and see, does your business generate enough cash flows to repay your debt? So in this case, in year 1, the debt service is £660,000. But the total cash flow available is £900,000. So it can cover, it's got sufficient, or it is projected to have sufficient cash flow and profits to repay its debt 1.3 times. So it covers it so many times. So that's a good indicator for the bank or the lender to have comfort that even if the business does not achieve the projections that it has, it still has a little bit of headroom to not only repay the debt, but also ensure that there is enough funding available in the business to carry forward. So it's a very simple exercise, and then you need to project, and you need to show, depending on the circumstances, you need to show that improvement in debt service coverage ratio. So in this particular case, it's grown from 1.36 in year 1 to 2.12 to 3 years. What that tells you is your capital, your debt service remains the same because of the way the installment is in this particular case. But then obviously your projections have forecasted a growth in revenue and profitability, and as a result, the debt service coverage ratio increases year on year. Another way of looking at debt servicing capacity is to look at your asset base. So we talked about two things. We talked about number one, assessing the funding requirement through the cash flows and how that's very critical. And then number two, we looked at debt serviceability through your profit and loss account and seeing how much profits you're generating and whether it is sufficient and there's enough coverage to your fixed debt commitments. And number three, what is your asset position? Right now, we all know when we approach the bank for funding, in most cases they ask, is there any security offered? What is the security available? So it's very important to ensure that when you make your bank proposal, that you delve into your asset base and you try to make sure that it's as detailed as possible. So in this particular case, this is why a balance sheet projection is very useful. So start at your starting position. Look at historical. What are my tangible assets? What is the breakdown of those tangible assets? What is the composition of my working capital? What's the stock amount? What's the debtor amount? What are the bank balances? What are the debt? What is the net asset position? So, and then how is that expected to increase over time? So that's why projections are very useful in understanding what your net asset position is now and what it's expected to be in the future. Now, I'd like to close by just giving you a few pointers on the asset base. So the first thing is it's very important to give a very detailed breakdown of all tangible assets in the balance sheet. Try and include as much as you can about those assets. If there are property or investments held, try and include a independent third-party valuation. If you've got property, it is very likely that you might have done a valuation in the last few months or years. Try and include that in the bank proposal, which actually substantiates and establishes the amount that you have in the balance sheet and can be extremely useful that way. If there are investments held, again, if those are private companies or even deposits and where there is, let's say, a lot of listed investments, you can actually take the market value and you can actually put some details on what the stock value is at that current date. So it helps establish the net asset value that you have in the balance sheet. The next thing is obviously on the charge on these assets. So chances are, if you've got bank funding, already have a bank funding, that there might be in existence of some sort of charge security on some of your assets, a fixed or a floating charge. So it's very important to indicate the assets that you have and whether those assets, especially those sizable ones, have an existing charge. So ensure that you clearly establish and you clearly outline that in your banking proposal. And of course, if you've got existing debt, make sure that you include the repayment structure, because it's very important that and this should be covered in your cash flow. It should clearly show, without taking the additional funding, is the business already able to service the debt commitments that are there. And of course, working capital is so critical, especially in a time like this. And we've been looking at so many businesses where, because of COVID, there's been a massive disruption in the working capital levels, debtor balances. Again, customers are asking time to pay, and so are creditors asking for payment sooner. There are a lot of deferred liabilities. So there's been a lot of movement around the working capital balances. So ensure that you include a detailed breakdown of what those working capital balances are. If there are deferred payments, ensure that you have details on how much is deferred, what that period relates to, and when it needs to be repaid. So you're able to give a very detailed understanding of what your asset base is and when you expect any sort of commitments to be paid in the future. So that concludes my session. Feargal, back to you.
Okay, thank you very much, Ashok. And just a few concluding comments. And it's fair to say that it's really important that you you're funding proof or proof fund your proposal. And the reason that is in our experience, your first attempt at your funding proposal is your best. And therefore, it's very important that in preparing your proposal, you anticipate what the funder is going to do with your proposal once they receive it. And to be upfront about it, they're going to carry out some financial analysis of your proposal and business analysis. They'll certainly look at sales trends and they'll compare to what they expect the market is expecting. They look at your gross margin trends. And Ashok has covered these in a little bit, but they will analyze your figures. So it's important you analyze them. And actually, the very smart proposals actually include these in it. You need to do the work for the bank. And again, your net profit margins, your productivity value added ratios, your working capital as a percentage of turnover, your debtor days, your creditor days, and finally debt equity. And we've covered all these under our KPIs webinar. But again, if you require any further assistance, I think if you contact Tourism NI, we'll see if we can potentially help you. Now, in terms of the core areas, in terms of funding, Ashok has highlighted these in his previous session, but it's important just to appreciate that, as he did in his financial modeling there are a couple of really sensitive issues in terms of debt capability, your ability to service your debt. And one is your times interest cover, which is in simple terms, which is Ashok called the operating profit adding back depreciation. It's your profits before interest, tax, depreciation, and amortization, and you put that purely over interest. So it's not the capital payment, it's the interest. And certainly in the current market, you'd be looking for that ratio to come in around 2, at least 2. And then you go to the formal debt servicing capacity, which is the one that Ashok demonstrated during his slides there, where he took the operating profit and he added back depreciation. And basically, he then put that over loan interest plus capital commitments. And I think Ashok's, if memory is right, came out at about 1.36 and then improved each of the next years. The truth is, if your debt servicing capacity ratio is coming in above 1.2, you're probably okay. The bank would not like it below 1.2. Again, other ratios they use to look at the whole debt area is a leverage percentage, and loan to value can be quite important. For example, if the core part of your funding proposal is to fund an asset or to fund certainly a major separate part of the business can be identified. In that case, quite often you may hear banks talking about their loan to value. What that really is the total debt facilities over the value of the security held. And obviously, they'll probably, given current experience, discount the value of the security. And that's why, if you notice, in most asset finances, you actually have to contribute a significant amount between what the funder is willing to provide and what the cost of the asset is. So again, what they would wish you to do, and again, Ashok highlighted this in an earlier webinar we did for Tourism NI, they'd like you to do scenario sensitivity analysis. What if, for example, we were delayed trading for a further month or 2 months? What's the impact of that on our projections? What's the impact of our sales individually within different categories? Go up or down 20%, or our gross profit goes up and down 20%. And none of these are right or wrong, but what you're trying to highlight is the sensitivities and the risks associated with the business. And if you check your own proposal before it goes in and you're happy with it, well, you've gone a long way. It's very smart. But more importantly, you're better checking it before it goes in. And if something looks unusual, then go back and think about it and see, can you amend it a little bit or change your rationale a bit? Because you can take it for granted. The funder will definitely look at these things. So in terms of the bank relationship, just focusing on bank for a second, it's fair that we would strongly suggest that you read bank letters, of offer very carefully. You review the security which the bank has sought and any covenants they require on an annual basis before you get too excited, because these will come back to haunt you if you don't read them very carefully at the outset. There's going to be a need now for greater and greater regular information being supplied to banks, but I don't think that's a problem, because I think actually that helps you run your own business as well, and you may wish to involve an accountant in the process. So just to conclude, a couple of smart summary points. If you're preparing a pitch for a finance, what we would suggest the do's are, if there's a funding requirement, identify it and then define it. Calculate the cost of obtaining the finance yourself in advance. Match the borrowings with the life of the asset. Discuss various options with a business advisor or mentor. Be aware of the risk versus reward that we touched on very early on in the presentation. And think about the funder's decision-making process, which we've just touched on. Why does the funders ultimately want to give you, want to help business? Because if they don't help business, they have no income. So they want to help businesses, but be very conscious of what is key to their decision-making process and try and address it subtly in your funding proposal. And indeed, shop around if relevant. Now, in terms of the don'ts, to be honest with you, don't overcommit the business. And this is really important. Make sure your projections are not too optimistic, because you got to remember you're going to be held to those projections, and there could well be covenants or key performance indicators put into the terms of the business over a period of a couple of years. And ensure that there is an ability, and this was the point that obviously Ashok focused on big time, ensure within your model and within the rationale you've prepared in terms of the assumptions that there is actually an ability to repay. Please, please, please do not go to the meeting with potential investors unprepared. Really key point. And to be fair, what we're really saying there is just pause, get it right the first time, prepare. As we said in a previous presentation, failing to plan is planning to fail. Don't ignore the basics of good management, and make sure you match the right funding with the right needs. Don't use short-term funds to fund long-term needs. In terms of bank funding, a few common shortfalls that we deal with banks regularly, and we get feedback. And a lot of things they get frustrated with is the generic proposal, which is not specifically tailored. Excessive commentary. People quite often like talking a lot and putting it into the words, and periphery analysis, but not getting to the core points. What is the funding required, and how much of it is required, and why is it required? Inappropriate sensitization of the financials, that's what I was doing there a few seconds ago. The scenario analysis, the appropriate funding mix, which we touched on, I think, at many times throughout the presentation. It's a key weakness. You got to make sure you don't fall into that trap. And insufficient challenge from your advisor. To be honest with you, you don't want your advisor to be a yes person. You want a challenge function, because it's far better as challenged before you submit the proposal to the funder. In terms of bank debt, just a few final thoughts. Banks aren't there to take equity risk, and it's fair to say also to remember that banks back people, not projections, thankfully, because business is all about people and relationships. Focus on the commercial reality underlying the cash flows. The figures aren't that about the underlying rationale. That's very important. Don't be too aggressive. Build in headroom, even if it means more equity injection in the first place. And be willing to invest in the building relationship. Now, again, obviously in the current environment, the difficult banking environment, without doubt, in an economic crisis. However, we are finding that banks certainly are willing to support their existing customers if they believe that a good case is being made. So I suppose what we're really saying is, for recovery and growth to take hold, confidence must replace fear. And we must convert natural anxiety into a passion to deliver positive results. Yes, we must approach the future with great hope and confidence in our own ability and in the ability of our team. The collective team is so important to offer best practice, because if you think about it, there's nearly one sure thing will happen. The fittest will survive and evolve much stronger from our current economic difficulties. So I think actually, if you think about it, in terms of hope and confidence and reality, it's nearly a bit like riding a bicycle. We've got to keep pedaling, because if we stop, we're going to fall off. Thus, we must try and keep moving forward and never be complacent with funding and cash flow management. If I could suggest, I always like to retain a constant state of nervousness, because I think then your belly. Complacency is the worst thing you can possibly do. Constant state of nervousness, and never be afraid of that constant state of nervousness, and focus on relevance, sustainability, and building trusting relationships with your funder. Remember, the day you get the finance from your funder is only the first day. It's what happens thereafter that's very important. So in conclusion, there is no doubt that the economic implications of COVID-19 for businesses operating in the Northern Ireland tourism sector are very challenging. But I think we'll all agree they pale in comparison to the public health and human costs that we're observing around us just at present. Yes, it is very difficult to predict the future market dynamics, because if you think about it, we're now faced with a triple COVID-19 uncertainty. Firstly, around the coronavirus itself. Secondly, its economic impact. And thirdly, the ways in which the pandemic has and will affect people's behaviour going forward. However, we would suggest that astute business leadership in terms of seeking and securing finance in the context of funding and cash flow management will be key to long-term business sustainability. And as we've said on a few occasions, our present circumstances don't determine where we go. They merely determine where we start. And if you think about it, whether it be coronavirus, whether it be Brexit, sometimes we cannot control the events around us. But we do have the ability to choose our response. And as sure as night follows day, if you think about it, individuals make choices every day. Individual actions matter and can be a force for change. And I would urge you to let's try and make every moment count. Yes, we'll make mistakes, but let's keep the energy levels high. Let's keep the long-term picture still in sight and realize that the difficult days of today will eventually get better, and there will be, hopefully, an exciting future for us all. It's also fair to appreciate that effort is admirable, but it's output that matters most. If today's webinar has raised an issue or a question that you'd like to discuss in private, you can get in touch via email. The email address is industry.development@tourismni.com, and Tourism Northern Ireland will organise that you get a call from a finance expert. Certainly, I'm looking forward to joining Ashok now, along with Patricia, for a question and answer session. And all that remains for me to do at this moment in time is to thank you very much for joining us for today's webinar. And we hope you found it beneficial. Thank you.